Thank you very much, Sue. Blockchain and market research, boom or bogus? Okay, spoiler alert, largely bogus. But let me take you through my thinking. So today's chain, what is blockchain? Well, a little bit of explanation, because you may have seen lots of people talking about it in the media and doing blog posts on it. But what really is it? What are cryptocurrencies? Why might market research be interested? And then I'm going to share you my somewhat disparaging view and then some thoughts about the longer term. So first of all, let's think about what is blockchain. Initially, back in 2008, blockchain was Bitcoin. Bitcoin was blockchain. It's really only since Bitcoin has run into difficulties that people have started separating them out and talking them about two separate entities. They were actually developed together, and so that was at the origin. Blockchain is a system where new information can be added to the system, and it can't be edited afterwards. So we have this phrase immutable. So a blockchain is somewhere where we can add information and we can be absolutely certain that it won't be distorted or changed. And many of these blockchains are stored in peer-to-peer. So there isn't one company, not a Rackspace or an Amazon that's storing the blockchain, but it's stored on lots and lots of different computers. So it moves away from this sort of central control. And here's an example of a super simple blockchain. We start off with the first block in the chain, and we'll call that the Genesis block. And like lots of computer languages, it starts with 0. So if we're counting people, we always start 1, 2, 3. But in computer worlds, you very often start with 0. So the first block is block 0. And when it's created, it's given a timestamp. So today we would say it's the 19th of March, and we would give it the time right now. And we can put a piece of data into that block. And then we create something called a hash, and that uses cryptography. It takes the index number 0, it takes the timestamp, and it takes the data, and it makes a unique number that represents all of that information. So now we know that if the hash doesn't match the rest of the data has been edited. And that's the first step in making it secure. Then another block is added to the chain. So it has got the index number of 1, it's got the timestamp, and it's got its own piece of data. And now we make a new hash for this block, and the hash of this block is based on the index of 1, the timestamp of 1, whatever data is in this particular block, plus the hash of the previous block in the chain. So now if anybody were to edit block 0, the hash of block 1 would be wrong. So we can see how the protection is building up. A third block is added to the system. It's got its own index, its timestamp, its own data. But now the hash is a combination of the 3 things in this block: the index, the timestamp, and the data, plus the hash from the previous block. And the hash from the previous block includes the hashes of all the previous blocks before that. So now we have a system where if anybody were to change any of the blocks in the chain, the hashes would be wrong. So when you come to accept a blockchain from somebody else, you look and see if the hashes are right, and if they're not, you don't accept it. And that is what we mean by immutable. Something is put in there and it stays like that. Now, what about cryptocurrencies? Well, the most famous cryptocurrency is Bitcoin, but there are lots of others. 2 leading examples are Litecoin and Ethereum. Whenever anybody talks to you about blockchain or about Bitcoin or the cryptocurrencies, you should always ask them, do you have any money in those currencies? Because generally, if you talk about the currencies, the value goes up. So there is a bit of a risk of a pump and dump sort of thing. I'll talk about the currencies, I'll drive them up, and then I'll sell them. So yes, I do have some money in those. I have enough money to buy a second-hand car. I do not have enough money to buy a new car. And before Bitcoin crashed, I had twice as much as I had today. Cryptocurrencies are based on blockchain. That is the technology that underpins them. And most of the cryptocurrencies are not backed by a proper government or a proper bank. There are some governments that are coming up with petrol cryptocurrencies. They are not based on anything tangible. Nothing actually exists. Now, to some extent, of course, that's true with ordinary money. If we wave our plastic card, our credit card, or our debit card around, and we get given some goods, and somewhere in the background there are accounting transactions, but there is nothing real. There is no gold. There is no essential value behind those. But that is even more true of cryptocurrencies. What do we do know about the cryptocurrencies, and Bitcoin in particular, is they're incredibly volatile. The values went up hundreds of percent, then it lost 50% of its value, which makes it a very unstable tool for commerce. Bitcoin, a little bit more detail now. So every 10 minutes, a new block is added to the blockchain. There is only one blockchain for Bitcoin, but there are many, 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 many copies of it. And every 10 minutes, a new block is added, and it adds all the transactions that happen during those 10 minutes. Well, it adds all the ones that can be added together and checked and verified. And companies compete to add the next block on. They will get given an award, so they will get paid if they are the company that does all of those validation checks the fastest with the most computing power, and they are the ones that add it. And so what you've got are lots of companies, mining companies they're called, who compete to be the person to add the next block in the next 10 minutes, and they will earn that. As a consequence, there are very few companies around the world who are Bitcoin miners. A very large percentage of those are in China at the moment. And one of the really horrendous things about Bitcoin is it now uses more electricity than the whole of New Zealand. And that is mostly from companies who lose that competition to do the new block every 10 minutes. And capacity of Bitcoin is becoming a real problem at the moment. To use Bitcoin, so if you and I want to use Bitcoins, I've got Bitcoins, you need an account with an exchange, a Bitcoin wallet. And there are about 16 million people in the world who use Bitcoin. So it's an incredibly small percentage of the world at the moment. Transfers are slow. So there are two pubs in the UK where you can pay for your beer with Bitcoins. One of the problems with that, of course, is you wouldn't want to wait 10 minutes for your payment to be validated. You want your beer. And not only that, most transactions are not actually validated in the next 10 minutes. They get put into a loop and they'll go around several times. And both of those pubs have to operate by giving people beer before the payment has been recognized and consolidated. And occasionally, they don't receive the payment, and they say that's about as common as being given a dud £20 or £50 note. So it happens, of course, with conventional currency, but actually transfers are much slower using Bitcoin than you might imagine. And the price of paying and receiving Bitcoins is going up and up. The amount the exchanges take is going up because the cost of earning Bitcoins through the mining process is going up. Now, people have been talking about blockchain and market research, and they've been saying it deals with the problem of checking the authenticity of participants. It gives us new payment. We can do micro payments to people who take part in research. It's going to give us compliance with the new European legislation, the General Directive on Privacy Regulations that are coming out in May. It will create personal data economies where we can all sell our personal information. It will create smart contracts where clients will have the opportunity of paying agencies automatically and on time, if that's what they want to do, of course. And people are saying it will remove the data silos. But are any of these things true? And are any of these things the major problems facing market research today? So I'm going to use as an example an interesting company called Earn.com. And it uses cryptocurrencies, it uses blockchain. And you can join Earn.com and say, anybody can contact me, it will cost you this much. So this is somebody who's saying, if you want to contact her about her baby being an employee of yours, pay $5 to her nominated charity, and you can get that. There is on there's a venture capitalist who says, pay me $200 and I will listen to you for 30 minutes to pitch your idea to me. So it's people saying, yes, you can contact me and you will have to pay this much. Either the money will go to charity or it will go to the individual concerned. And you could imagine, wait a minute, what if we did sample this way? If people created themselves as potential sample people, they're in here, we could go through, we could find the profiles of all the people we're interested in, all of their back data is stored in an immutable format, so if we put a smart contract in place, we could use them to collect our data. Well, what would have to happen for Earn.com to be a game changer in the sort of terms that are used in this world for sample provision? Well, the first is they'd have to be capable of generating samples that were big enough and representative enough. They would have to be hundreds of thousands of people in your country who were a member of Earn.com. Now, that is a challenge because in lots of countries, cryptocurrencies are not even legal. And we know that only about 16 million people around the world have got these sort of wallets. So there are some real barriers to generating a really big collection of people, say 1 million people in the United States, say 500,000 people in the UK, say 300,000 people in Finland. You can see the challenge there. As well as having all those people signed up, they need to be able to generate quota samples and integrate with the research process. We don't simply want people volunteering to do our survey, but we end up with nearly all females, or we end up with nearly all males. We end up with people over 35. We have to have a system where we as the researchers are choosing the quotas. It can be in conjunction with the members of the community, but there have to be systems. We have to avoid that self-selection. We also have an issue in market research that we don't want to get mixed up with marketing and market research. And Earn.com is, yes, you can send me your marketing materials, but you have to send me $1 every time you send it. Yes, you can send me your survey request. You're going to have to send me $2 each time you send it. There is a risk of conflating the two. And we want to be able to avoid paying for bad interviews and removing bad participants. So one of the advantages of the concept of a smart contract from a respondent's point of view, a research participant, is the moment you finish the survey, the smart contract would pay you your fee. But actually, from a researcher's point of view, we want to know that the data has been validated and that it's good and it looks like you are paying attention before we pay you. And what's more, we want to remove any information about bad participants and we want to make sure that we don't use them in the future. So we have a very different incentive for when the financial transaction should happen. And if Earn.com were to master all of those things, would it be a game changer, or would they simply be a new, large, high-quality panel provider, which is not a game changer, it is just business as usual? I want to tackle this data in silos issue because I think it's fairly fundamental. I keep hearing from the people who are advocating blockchain that this is going to be a game changer. So imagine our super simple blockchain. And in the first index, we have the timestamp and we put into the blockchain a research brief for a project, which might be an email. And we give that a hash. And then we add in another block to the chain. And this time we've got a CSV of the raw data, a comma-separated variable ASCII file of all the data we collected. And then we've done some analysis. So we put the SPSS file into the blockchain. And then we produce a report and we put the PDF of the report we produced into the blockchain. And then we create a video for the debrief and we put that into the blockchain. Have we actually removed the silos? Not really, because we can't process those different sorts of data with one tool. They all require different tools, some of them proprietary tools like the SPSS file. So what we have done is we've simply put this information unstructured into a new structure, but left the elements unstructured. So when I challenge people who are advocating blockchain, they said, oh yes, well, of course, if you put it into blockchain, you would put it all in a single standardized format, something like the semantic web or Web 3.0. Yes, if we had such a thing, but we've been trying to create that for 10 years now. There has been zero progress in creating an industry standardized single format for all information. And if we did have that, we wouldn't actually need the blockchain solution because we would have the single format to access everything. So actually the data remains in silos, even if we lock it into blockchains in this way. So what I think is going to happen in the near future, not many people are going to be using cryptocurrencies, so systems based around paying for survey responses in cryptocurrencies are going to be really niche. Bitcoin is too volatile and it's got capacity problems. It's getting really big, really slow, really clunky, and almost no value is transmitted through it. It can only handle 7 transactions a second globally, and that is super tiny. And too volatile. Do you really want to agree a contract in cryptocurrencies when it might end up only delivering half as much money or a quarter as much money to you as you thought it was going to do last week? Some countries ban cryptocurrencies, so we can't have, with the current thinking and the current laws, a global solution. This is quite an interesting one. The General Directive on Privacy Regulations that's coming out as absolute law in the European area from May, and anybody who does does business in Europe or with European data, includes a right to be forgotten. So the concept of immutable data is really in competition with this, and you will hear some advocates for blockchain saying it's the best way to implement GDPR. Most people I speak to say either A, it's impossible to mix blockchain with GDPR, or B, you have to modify blockchain so that you can erase the keys to make the data in some fields inaccessible. So there are some real challenges there. But this, I think, is the biggest issue. There have been some fascinating conversations on LinkedIn about this recently. Blockchain may or may not deal with some possible problems, but none of those problems are the main problems facing market research at the moment. What are the main problems facing market research at the moment? Long surveys, poor storytelling, non-representative samples, a lack of consultancy skills. All of these are the really core problems facing market research, and blockchain doesn't tackle any of those at all in any way. You could even argue it's a distraction. The longer term, well, first of all, blockchain 3.0 will come out. It will make some differences. We may see some real improvements, and that may create some possibilities for market research. But remember, so will artificial intelligence, so will automation, so will virtual reality, so will augmented reality, so will quantitative semiotics. So blockchain may be an interesting feature, but it's going to be one amongst many possible candidates. A good bank or a government, if the United States launched a cryptocurrency, or if Citibank were to launch a really credible one, Credit Suisse were to launch a really credible one, that might change how cryptocurrencies worked and were accepted. Niches such as documentation and code and accounting are going to be used. Counting for hundreds of years has been based on immutable records. You can't correct a mistake you made by changing the old records in a good accounting system. You have to add in a new item to the ledger to say, and now we have made this adjustment. So some of those could be a part of market research in the future. So thank you very much, and I hope that my views on boom or bogus for blockchain and Bitcoin have been of some interest and use.
Thank you very much, Ray. Ray, you tend to have suggested that you think this might be bogus. If you had to allocate 100 points to how likely it is to be bogus or how likely it is to be boom, how do you split those?
I would probably hedge my bets a bit and say 99 bogus, 1 boom.
Okay, so I think that answers that question nicely.
I think just on that, I should probably make the point, I don't think that everybody advocating blockchain and Bitcoin is bogus. I think quite a few people believe it. That being said, outside the market research industry, I would say that most advertising I see for cryptocurrencies and blockchain, most articles I see advocating it are scams, bogus, from people who have a financial interest in promoting that. So I think within market research, we have got some people who are really interested and I think are slightly wrong. But beyond that, be very careful. Somebody offers you that looks like a deal that's too good to be true. It will be.
Oh dear. So you've pretty much put the knife in any hope of cryptocurrencies in the market research space. I know that you're at IIX not long ago. Was there any other sort of innovations on the near horizon that aren't blockchain or cryptocurrency, but are perhaps interesting innovations in terms of things like data security, micropayments, different ways of administering smart contracts that perhaps look promising but are just not in the blockchain model?
Okay, we'll split all of that into 2 groups, smart contracts, 1 group, everything else in the other. I think the first thing we should say is that what we saw from the panel companies and people like that is the immense amount of progress they have made in terms of apps and passive data collection and micropayments. Then we look at Africa, who've had micropayments really for years and years and years. Not IIX Amsterdam, but if we look at IIX APAC, which happened back in December, and we look at the micropayments in China through WeChat, there is an immense amount of stuff that is actually tackling these problems. And so I think all of that is moving ahead really quickly. So I think one of my concerns about the blockchain and cryptocurrency route is that many of the problems they're talking about are problems that are being tackled. And in particular, one of the things that I think was quite interesting in Amsterdam, if we take GDPR and these new data privacy regulations, they are potentially a massive boost for the large panel companies who do collect that sort of permission, who do have the right sort of processes in place, compared with somebody who is perhaps running DIY research on their customer database, but hasn't put all of the things in place, doesn't have a legal data protection officer and so on. So I think that is quite interesting there. I think there are masses and masses of other technologies that are doing really great things. Smart contracts, just a little bit back. Now, the idea behind them is you write smart contracts. So there are things like Ethereum, they have their own language called Solidity. And you write a contract and then it automatically happens. So let's say you write a contract for a music company to say every time this song is played, you will get paid this much money. The problem is that humans can't write good enough contracts for machines to be able to implement them automatically. So who proved that the song was played and was heard in that audience. So that is going to, a human would have to do that. They call that an oracle by and large. Somebody's got to input it into the process, and that could be challenged. It could be disagreed. And remember, this is an immutable system. So it's really problematic. And then we get to the payment end. Well, if you know that the payment is guaranteed, then you would always have to leave enough money in your bank account, in your Bitcoin wallet, to pay every bill that might fall due, which is just a ludicrous waste of money. Or there is a risk that when the money is due to be paid, there isn't enough money to pay it. And so that then has to be overseen by a human too. So non-trivial smart contracts are beyond human programmers and coders for the foreseeable future, in my humble opinion.
Last question that we've got time to ask you about this is, when do you think we will see people stop talking about blockchain in market research?
When the next unicorn comes into sight, so I think several years.
Okay, we'll mark that down and come back and check it. So thanks very much, Ray. We've managed to wrap up all of the questions that you've been asked. But if anyone's interested, I know Ray's got a blog up on the NewMR site. So if you think of some questions afterwards, you could probably pop them into the comment section there, and I'm sure Ray would be only too happy to answer them.